So how to know when to roll your options, your naked options. So the first thing I'll say, I don't think there is one right approach, one right answer, but I'll share what I like to do and why I like to do it this way. So what do you do when you've got an option that you sold that is completely breached or tested? When do you roll it? Do you roll it before it gets breached? Do you roll it after? Do you wait till expiry? When do you actually roll it? So I like to roll my my breached puts. I sell naked puts mostly. I don't sell naked calls, so I'd like to roll my naked puts not once they get tested, only when there's no more extrinsic value left in the put option. So let's look at an example. I've got, for example, pins here, the 65 put. You can see that it's completely breached, right? So pins is trading at around, let's look what it, I think it's trading at around 44 or something, 45 maybe. So it's trading at around 44.68. In my positions here, puts, I've got a 65 put. So it's completely breached, completely in the money by 20 points. But I've got a November 19 expiry. So I still have 16 days to go to expiry. But as you can see, it's showing a big loss. And actually, it shows here credit received of 11, but I didn't actually receive $11. My total net credit on the trade is $5. So if I were to close a trade right now, I'm actually, if we look at what it's trading for, it's worth $20.30. So $20.30 minus the $5 of net credit that I received, I'd be losing $15. I've got two contracts, so times 200, that's $3,060 US that I'd be losing if I close the trade right now. So even if my strike is completely breached, I won't roll. What I'll do is I'll wait till expiry. And the reason that I like to wait till expiry is I don't want to pay for extrinsic value. I don't want to buy back the option just to roll. But at the same time, when I'm buying it back, I'm paying for some extrinsic value. So how do I know if there's extrinsic value left in the put option? Well, there's two ways really. Well, there's actually three ways. Some brokers, they'll actually show you in the option chain. So if I look up the option chain on pins here, some brokers will actually show you that there's a column that you can add, and they'll show you that they'll show you the extrinsic value left in the put option. So you can see the intrinsic value and the extrinsic value. But with Questrade, we don't have that. If I go to columns here, there's nothing here that talks about extrinsic value of the option. So it's really simple. I mean, all I do is I'll remove the intrinsic value of the option. And how do I calculate the intrinsic value? Well, it's how in the money it is. So if I've got the 65 put and the stock is trading at 44.6, I said, let's check again, pins, 44.68. So if it's trading at 44.68 and I've got the 65 put, so 65 minus 44.6, I am $20.40 in the money. That's how much, so that's how much intrinsic value the put option has. Now, what is it worth? The put option is worth $20.30. So this is not accurate, the $20.30, because there's no way that it would be worth less than the intrinsic value. It's going to be worth at least the intrinsic value plus a little bit of time value. So if I click on it, maybe it's just not showing the accurate price, but you could see that it's trading, the bid is 20.25, the ask is 20.55. So if we pick a price in the middle, it's just showing us the last traded price. But if we pick a price in the middle, so 20.25 plus 20.55, we've got 40.8 divided by 2. So it's trading at exactly how much in the money it is. So remember I said I'm $20.40 in the money. And right now the option is trading for about, the mid price of the option is about 20.4. So that means that there is no more intrinsic, there is no more extrinsic value. There's no more time value left in the put option. So that's actually a sign that, early assignment is possible in this case, because there's no more extrinsic value left in the put option. Early assignment is possible. Most likely it's because it has earnings. After earnings, if the stock doesn't fly, there's a good chance that I get early assigned on this stock, because there's no more extrinsic value left in the put option. There's no more time value left in the put option. So technically I should be rolling right now, but I want to give it a chance after earnings, a small hope that maybe the stock comes back up and I get a better price to roll. Because right now if I roll, I'm not going to get much credit. Another way to see if there's extrinsic value left in the put option is to look at the corresponding call. So if I look at the 65 call for November 19, whatever it's worth, that's how much time value is available in the put option. Usually you can get a good idea by doing that. So let's look at the option chain for pins. And where is the 65 call? So first I'm going to look for November 19 expiry, then I'm going to look at the call side, and I'm going to look for the 65 call. I'm stuck at 48. I need to add more strikes. Click on all strikes here. Go to the 65 call. I'm afraid to look. So as you can see, it's trading between 13 cents and 15 cents. So it's got so the put option, the 65 put should have about 13 to 15 cents of extrinsic value. So probably that's why I didn't get assigned yet. But it's, as you can see, it's very little extrinsic value. So I should start considering rolling, but I might as well just hold on to it a little bit longer just to see maybe by expiry, maybe it comes back up and I get a better fill. But if I were to roll it right now, let's see what I can get. So I'm going to click on buy and sell here. So I'm going to click on custom here, and then I'm going to add the put again. I'm going to add another one. So I basically have to buy the November 19 at the 65 put, and I'm going to have to sell. Let's see if I can sell a December one for 65 put again as well. So basically this is what rolling is. It's buying the in the money option that you have, the one that's in trouble, and then just selling the same strike but a different expiry going forward in order to get an extra credit. But as you could see, I would not be getting any credit. Or at least it's very little credit. So it's not going to be a good roll. I'm basically just pushing it forward, waiting for the stock to come back up, but I'm not getting any credit from it. If I try a further expiry, if I go to January, then I can get maybe 20 cents, still not worth it. What if I go to February? Yeah, so if I go to February, I get about 60 cents of credit, which is still sad. If I go to May, I can collect a little bit more, but as you can see, it's holding a lot of buying power and I'm collecting very little credit for the amount of buying power that's holding. So that's one of the risks of naked puts, is if you are completely breached, you could still roll for a credit, but it's not a good efficiency of buying power, because it's probably taking about, I don't know, 7,000 buying power and I'm only collecting $200. Let's see what happens if I go to January 2024. If I go as far as possible, I can collect maybe about $5. Let's see if I can bring the strike lower. Ideally, I'd want to bring the strike lower, so I can roll it down. I could roll it down to even 57.5 maybe. No, so rolling it down to 57.5, I would have to pay. So remember I said if I look at my trade log, the total credits that I received on pins was $5. So maybe it's time to give back those credits just to save the trade. So where's my 65 put on pins here? Let me just zoom in. So pins 65 November 19 should be around here. There we go. So you see I collected a total net credit of $5. So maybe I could roll for a debit. Maybe I can pay it back. I don't have to collect all that. I don't have to hold on to my credit right now. 20 points in the money. My goal should be to save the trade, you know, try to get out without a loss, try to get my buying power back so that I can have more confidence in trading more, making more trades. So let's go back to something decent like a December expiry, and let's see if I go from 65 to 60. See, I can pay that $5 that I was talking about. So I can give back all my credit that I received. But what I'll do in exchange is I'll lower my strike from 65 to 60. And this way, I wait for the stock to come back up. Instead of waiting for the stock to come back up to 65, I wait for the stock to come back up to 60. My buying power will be, I'll be using less buying power. Let's see how much more less. So if market price is 45 and I've got the 65 strike, it's using about 33.50. But if my strike is 60, it's using 28.50. So from 33.50 to 28.50, so about $500 less of buying power by bringing my strike 5 points lower, which makes sense because it's 5 points in the money. And if I have 2 contracts, then that's $1,000 difference. So that's potentially a trade I could do. I could go a little bit further. I could go to January so I can pay a little bit less, but as you can see, it's not that much less. If I go to February, I'm still paying about $4, but at least I keep $1 credit. Maybe I try to lower the strike even lower. Or what if I go to January 2024 and I decide to roll for a debit? Let's see which strike I can go to. I could go even lower. I can go to maybe 50 strike. So 6 plus 3 is about, so this is about 10, 5. So yeah. So I can potentially roll from 65 to 50, but going to January 2024 and paying $5. So I'm giving back all the credit that I received from this trade. So basically it would have been a waste of buying power that I've been using all this time. What I'm doing, the advantage of doing that is I'm releasing buying power. I'll be releasing about $3,000 of buying power because I'm bringing the strike down by 15 points. And I've got 2 contracts and I can move on, and now I just need to wait for the stock to be above 50 by January 2024, which definitely has a good chance of that. It'll happen before January 2024, but that's a potential roll, and that's how I like to roll actually, is just to try different strikes, different expiries, see what I can get. But initially I like to start off with the next month expiry, but as you can see, next month I don't have anything available, not enough premiums, unless I add a contract. So I could add another contract, and this way I could bring the strike lower. So if I add another contract, so initially I have 2 contracts. So if I start off with 2 contracts and then I make it into 3 contracts and I go to December, I can roll for a credit by bringing the strike from 65 to 60, but I add another contract. But the stock's trading at 45, so even 60 isn't that safe. So what if I go to 55? Now, see, this would have to be for a debit. So what if I do 57.5? This will be for a smaller debit. So what if I go to February? I could go to 55. No, I can't go to 55. So it'd still be for 57.5, but I'd be getting a nicer credit. What if I go to January 2024 and I add a contract? I can go to 50 strike. I can still get a credit. If I go to 45, I would do it for a debit. Yeah, that sucks. What about 47.5? I would still do it for a debit. So I could go to 50 for January 2024, and I could do it for a nice credit of $450. But by adding a contract, but I bring my strike lower, and I collect 450, and I've got the 50 strike, which will make my buying power much less. But I just added an extra contract, so actually buying power will go up a little bit, but at least my strike is safer. But I already have 2 puts on pins right now, 45 and 41. So I really need pins to go up after earnings. That'll help me. So I'm going to decide what to do with this after earnings. And then I'm gonna have to roll for sure. I've got Zillow here as well. 75 put for November 5th. It got completely breached today. I sold it yesterday for $1. Today it's worth $10 because Zillow dropped all the way to 60. It actually reached 65. After hours, it went back up to 68. So as you can see, my strike is 75. Well, let's see what it was. Well, let's see what it closed at, just to be more accurate. So Zillow, let's look up Zillow. So it closed at 65. So this is about $9.53 in the money. So my put option should be worth more than that if it still has time value, which it does. So you can see the 75 put is worth, it's worth almost that. So there's very little time value left in the 75 put option. And if we go look at the corresponding call, you can see there's 20 cents of extrinsic value in the 75 call. So that's how much time value or extrinsic value is left in the put option. So I don't have to roll it right away. I don't have to worry about early assignment either, because there's still 20 cents of time value. It's expiring in 2 days. But definitely I will roll this. I'll take action and roll this probably Friday, end of day. I don't think it'll get assigned early. And here, the way I would roll it. So let's see how I would roll this position. So by November 5th, 75, I've got the 75 put, then I would sell. So let's look at December. I'd go all the way to December expiry, the monthly expiry. And let's look at the 70 strike. So if I keep the 75 strike, I can collect a credit of about $2, not bad. If I go to 70, I'll have to pay for it. So what if I add a contract, then I get a nice credit? What if I lower it again? I go to 65, I could do it for maybe $1.40. Definitely 60, I can't get anything. Yeah, so I could probably go to 65 if I add a contract. If I don't want to add a contract, then I'll have to stick to the same strike. Or I can go a little bit further in expiry. Let's do February. I can get $5 at the same strike. If I go 70, I can still collect about $1.50 at a 7 by lowering the strike. If I go to 65, I have to pay for it. So let's just for fun, let's just see January 2024. With one contract, I can go to 60 for a credit. I can go to 50 probably. Yeah, no, I can't go to 50. I can go to 55 for a credit of about $2.50. So not bad as well. So these are just some possibilities or ways of rolling. But the idea is, when do you roll? Or there's no right answer. I like to roll when there's no more extrinsic value, even if it's in the money. So some people will roll before it even gets tested or breached. So they'll roll it before it gets in the money. The reason I don't like to do that, and like I said, there's no right answer, but the reason I don't like to do that is because there's a probability of almost 2 times the original delta. So if initially, let's say the 75 strike had a 20% chance of being in the money at expiry, well, there's a 40% chance that the strike gets tested. So if I take action, if it gets tested, that means there's most likely, or more often, I'm gonna take actions sooner, because there's a 40% chance that it gets tested, as opposed to a 20% chance of expiring in the money. So if I just worry about what happens at expiry, then I'm gonna have a better chance of winning. But if I worry about what happens if it touches, then I'm gonna be managing too soon. And what if it touches the strike, but there's still 28 days of expiry, 28 days before expiration. So if there's still 28 days before expiration, there's gonna be a lot of time value left. So let's look at an example. So what, Zill's at 65. Oh, let's pick another stock. Let's pick, I don't know, whatever. Let's look at Lightspeed. So let's look at, let's say I had the 100. Let's say I had the 100 put that I sold for November 19. Lightspeed is at 98 right now, so it breached my strike, right? But as you can see, the put option is worth $8, but I'm in the money by $1. So it has at least $7 of extrinsic value. So if we do it the long way, bring out the calculator here. So my 100 strike minus the current market price, 98.97. So there's $1.03 of intrinsic value. Yet my 100 put option is worth $8.40. So that means there's about $7.37 of extrinsic value in this put option. So if I roll it right now, just because Lightspeed touched my short strike, I'm going to be paying $7 just for nothing, just to close this one and roll it to the next expiry of December. And just to confirm that there's $7.37 of time value. If you look at the call, the corresponding call, it shows about $7.50 of extrinsic value. So makes sense, pretty close. So I prefer to roll when basically all I'm paying for to close my existing put is intrinsic value, not time value, not extrinsic value. So right now, if I rolled this right now, I'd be paying $7 of extrinsic value. But if I roll Pinterest, even though it's really in the money, I'm not paying for any extrinsic value. I'm not paying for extrinsic value, sorry. I'm just paying for intrinsic value. So that's just a preference. I definitely don't think there's one right approach, but I just wanted to explain why I prefer rolling it this way. And sometimes it comes back up at expiry, comes back up and becomes safe, and I get a better roll as well. But if I roll too early and I just keep rolling every time it touches, then I'd be over managing. I won't be necessarily getting the best rolls because I'm paying for so much extrinsic value. And I might be taking action for nothing when the trade would have been a winner as well. Because the strike getting tested will happen more often than the strike being in the money at expiry. So you'll definitely be rolling more often if you decide to roll as soon as it gets tested. So going back to Zillow here, I'm going to wait till Friday with hopes that it comes back up. And I think I'm going to go to December 17. And I'll probably keep the same strike and just collect a nice an additional $2 credit. I already collected $1, so that'll put my break even at about 72. My break even would be about 72. If you look at the chart on Zillow, I mean, yeah, let's look at the past year. I mean, it had a high of 199, and right now it's or 208. 52-week high is 208, and right now it's trading at 65. I don't understand how things like that can happen. It's got a PE ratio of 145. Well, at least it's making money. It's profitable, but it does have a high PE ratio, so that's not too good. And as you can see, we're right over here. 6 months, 3 months, 1 month. Yeah, pretty big drop. But I don't know, if I just look at the chart, 75 seems good because it's just not even there. But yeah, I mean, I did have a put on Spotify at 260 that I kept rolling for almost 6 months. And where is Spotify right now? Spotify is at 298. And at some point when I had that 260 put, Spotify was trading at 205. So it's hard to hold on to it, but eventually, if it's a good stock, it'll eventually recover. And Spotify isn't even profitable yet. It's got negative earnings per share. Let's see if I go to February for Zillow. I'm just curious. If I go to 70, I wanna lower the strike 65. Yeah, I don't think I want to add a contract. So yeah, if I add a contract, I can go even lower. What if I go to December and add a contract? So yeah, I can't even do 60, 65. Yeah, I could probably add a contract and do 65. Yeah, I think I'll just stick to one contract and stick to 75. Yeah, I think that's what I'll do. It depends how in the money it is. If it comes back up and gets closer to 75, then I'm gonna stick to 75. But if by Friday it's trading below 65, then I might have to choose a further expiry and maybe add a contract. We'll see. All right, so just want to share when do I roll my naked puts, naked options. So if you have any questions, leave in the comments section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Thanks for watching.